I'm Adrian Cudby and I am the author of Commercial Lending Principles and Practice. I want to talk to you about what happens when businesses get into financial difficulties. Often when bankers lend money, they never think about what might happen when things go wrong. So this is the part of the book which is very important in terms of thinking about what are the remedies, what are the solutions. I want to think particularly about what are the warning signs. Bankers need to be very aware of warning signs. Management information is a key indicator of what is happening in the business. A very, very simple sign that a business is struggling is often delays in getting that management information. You might normally want that, say, within a month of the month end. If you're not getting that, you then have to ask questions. Are they too busy, or they simply have bad news they don't want to deliver to you? The next thing to think about is falling turnover. Your internal system should tell you if you're starting to see a fall in turnover. And sometimes, unfortunately, customers divert income. So let's say you've got a customer who has commercial property, they can divert the rental income somewhere else. So again, that's a very big warning sign. The last thing is called hardcore borrowing. So if you think about a customer that has an overdraft, overdraft should fluctuate from credit to debit. If you see a situation where you've got a hardcore position, which means it doesn't fall below a certain level of overdrawn position, that says to you there's something the matter, and it might be that you've got losses. So, if a business is facing financial difficulties, the bank will sit down with them and they'll talk about where do they go from here. There are things that a business can do, and these are things that the bank would expect the customer to explore. The first thing is the directors or the owners. Do they have money to put into the business? And sometimes in the past, directors and managers have taken large amounts of money out of the business in salaries, in dividends. Can they put some of that back into the business? If you look at, say, falling turnover, what is it that can be done to increase that? So marketing, etc., that's something that could be explored. The next thing is looking at costs, looking very, very carefully at the cost base and seeing if things could be done differently. Reviewing the supplier base, looking at terms of credit, and again, looking at those key suppliers without upsetting them. Can you change terms of trade that might help in terms of profitability? And the last thing is thinking about things like stock or inventory. Think if the business has stock, does it have obsolete stock? So if you think about, say, sports, somebody who sells sportswear, have they got lots of old stock, old football shirts that really just need to be sold or taken out of the business in order to reduce the level of holding? I want to also now talk about insolvency processes. There is a lot of jargon used about insolvency, and it's very, very easy for bankers to get confused with the kind of insolvency terms that are used. We often talk about bankruptcy, and you'll be very aware from US type reporting that large businesses in the US, when they go bust, they go into some kind of bankruptcy. Here, particularly in the UK, we don't talk about bankruptcy unless it's individuals. So individuals, sole traders, partnerships can go and can be bankrupt, but limited companies can't. They will go into some other kind of insolvency process. So, just to finish this, if you think about when you're lending, think about the external pressures on businesses that you deal with. If you think about, say, the retail sector, retail is struggling all over the world because of the rise of the internet, because people are shopping in a different way. So think about how your customer is countering that challenge. What are they doing differently which puts them in a very strong competitive position?